Hi, this is Azad Ahmed, and I am going to be reviewing with you depreciation valuation methods, that is the straight line method and the declining balance method for evaluating depreciation or amortization. So this is a topic in chapter 12 in the CSC, the Canadian Securities course. So let's take an example of an equipment which is costing $100,000 for the company. So this cost of $100,000, they will be accounting for that on their balance sheet, and on the profit and loss account the depreciation will be accounted. So let's suppose at the end of 10 years its salvage value will be just $10,000. That is all it will be worth after 10 years, after which it will not be of any benefit for the company. They would need to replace it. So in this situation, if we calculate the straight line depreciation, what we do is, first step is to calculate the total depreciation. The total depreciation will be the equipment cost, which is $100,000, minus the salvage value, which is $10,000. So if we minus that, we basically are saying that the total depreciation over the 10 years is going to be $90,000, which we have to account for. The company is basically going to be have to account for that, and this is over 10 years. So the second step will be, we will take that total depreciation, which is 90,000, and we will analyze it. We will divide it by 10, saying that since this is for 10 years that we are going to be having to account for this. So what we're going to do is, we will put, this will be $9,000. $9,000 will be the depreciation amount that we will account for every year. So we will basically take $9,000, and every year that will be minused from the that will be minused in the profit and loss account. So this is basically the how to calculate the straight line, and this is mainly used by, this is the most frequently used method by Canadian public companies. The declining balance, in this case, what we do is, we do not worry about what is the salvage value. We just basically take, in this case, that is 100% of the amortization, and we divide it over the number of years. So in this case, we take 100% of the amortization and divide it by 10 and multiply. So what we do is, we take 100% and we divide it over the number of years. So in this case, we got 10%, right? And this is also called double declining balance, because then what we do is, we multiply it by 2, and we in this case get 20%. So 20% is the amount that we will decline. We'll impose that as a cost, as a depreciation cost for the company every year for this equipment. So how we calculate that is basically like, in year 1, we have $100,000 is the value of the equipment. So 20% of that is 20,000. So we are left with $80,000 as the new book value. This will be the new book value, right? So that is how it will be in year 1. In year 2, we have here as $80,000, and we will then minus 20% of that. So 20% of 80,000 is $16,000, and when we minus that, we end up with $64,000. This is the new book value in year 2. And similarly, in year 3, we will have $64,000, and then 20% of that is $12,800, which we will minus from there, and we will be left with a book value of $51,200. So as you can see, in this case, this is a method of declining balance, where we just take 20% and minus that every year. In this case, we are only going to be minusing 9,000 every year. So in year 1 we have, for example, $100,000, and we're going to minus $9,000, so we will have left there $91,000 as our book value. So, and similarly this will continue every year. So this basically hopefully will explain to you in a more clear manner what the two types of methods are and how to use them. And this is a topic in the Canadian Securities course. My further information is given down at the bottom at the video. Have an excellent day and talk to you soon. Bye for now.